What if I told you that the difference between retiring broke and retiring with over $1 million has nothing to do with how much you earn, but everything to do with what you do with that money starting today? Right now, there are two versions of your future. In one version, you work for 40 years, save diligently, and still struggle to pay bills in retirement. In the other version, your money works for you, growing quietly in the background while you sleep, building wealth that sets you free. The difference between these two futures? A decision you make in the next 20 minutes. I'm going to show you exactly how regular people earning average salaries, build serious wealth through investing. No get-rich-quick schemes, no gambling, just a proven system that has created millions of millionaires worldwide. If you invest just $300 per month with average market returns, you could potentially build over $1 million during your lifetime. But nobody teaches you how to start investing safely, and beginners usually lose money because they follow hype, trends, and social media get-rich-quick advice. Today, that changes. Before we talk about building wealth, let me show you why doing nothing is actually costing you money right now. Meet your invisible enemy, inflation. Most people think saving money in a bank account is safe, and in one way it is. Your money won't disappear. But here's what they don't tell you. That money is quietly losing value every single day. If inflation averages 3% per year, your money loses half its purchasing power in just 24 years. That means the $50,000 sitting in your savings account today will only be able to buy what $25,000 buys today when you're ready to retire. Think about that. You're working hard to save money, and inflation is working even harder to erase your progress. Your savings account might give you 0.5% interest, but inflation is taking 3%. You're losing ground every single year. This is why wealthy people don't just save money, they invest it. Now, let me show you the weapon wealthy people use to fight inflation and build serious wealth. It's called compound growth, and Albert Einstein allegedly called it the eighth wonder of the world. Here's how it works. When you invest money, you earn returns, let's say 8% per year on average. But here's where the magic happens. Next year, you earn returns not just on your original investment, but also on the returns from last year. Your money starts making money, then that money makes more money, and it snowballs. Let me give you a real example. If you invest just $300 per month with an average 8% return, after 10 years, you'll have around $55,000. After 20 years, around $178,000. After 30 years, around $450,000. And after 40 years, over $1 million. You only contributed $144,000 of your own money over those 40 years. The other $856,000, that's compound growth doing the work for you. This is the secret. Time multiplied by consistent investing equals wealth. Not luck, not genius, just patience and consistency. Now, before you get too excited and throw all your money into investments, let me explain something crucial. Risk versus reward. Not all investments are created equal. Some are safe but grow slowly. Others can grow fast but are risky. The key is understanding where different investments fall on this spectrum. At the bottom, you have savings accounts and government bonds. Super safe, but returns barely beat inflation. In the middle, you have index funds and ETFs, diversified investments that balance growth with stability. And at the top, you have individual stocks, crypto, and day trading, potentially high returns, but also high risk of losing money. Here's the mistake most beginners make. They jump straight to the high-risk stuff because they see someone on social media posting about massive gains, but what they don't show you are the massive losses. For every person who makes money trading crypto, there are 9 who lose. Smart investors, the ones who actually build lasting wealth, start in the middle. They focus on balanced, diversified investments that grow steadily over time without gambling their future. Here's something critical that most YouTube finance videos skip. Before you invest a single dollar, you need to fix your financial foundation. Think of investing like building a house. You can't build a mansion on quicksand. You need a solid foundation first. Here are the 3 things you must have in place before investing. First, pay off high-interest debt. If you're carrying credit card debt at 18% interest, paying that off is actually the best investment you can make. You're guaranteed an 18% return by eliminating that debt. Second, build an emergency fund. 3 to 6 months of living expenses in a savings account. This is your safety net. Without it, you'll be forced to sell investments at the worst possible time when emergencies happen. Third, have stable income. Investing works best when you can contribute consistently without worrying about next month's rent. I know this sounds boring. You want to start making money now, but trust me, skipping this step is the fastest way to lose money in the market. Because when life happens, and it always does, you'll be forced to withdraw investments early, often at a loss. Fix your foundation first, then invest. All right, you've built your foundation. Now let's talk about where beginners should actually put their money. The answer? Index funds. An index fund is like buying a tiny piece of hundreds or even thousands of companies all at once. Instead of trying to pick which single company will succeed, which is basically gambling, you buy a little bit of everything. The most famous example is an S&P 500 index fund. This tracks the 500 largest companies in America. When you buy one share of an S&P 500 fund, you own tiny pieces of Apple, Microsoft, Amazon, Google, and 496 other major companies. Here's why this is powerful. If one company fails, it barely affects you because you own 499 others. But if the overall economy grows, which it has historically done over long periods, your investment grows with it. Over the past 50 years, the S&P 500 has averaged about 10% annual returns. Some years it's up 30%, other years it's down 20%. But zoom out over decades, the trend is clear, up and to the right. Even Warren Buffett, one of the greatest investors of all time, recommends index funds for most people. He literally bet $1 million that index funds would beat professional hedge fund managers over 10 years, and he won. Now let me show you the strategy that removes all the stress, anxiety, and guesswork from investing. It's called dollar cost averaging. Here's how it works. Instead of trying to time the market, buying when it's low, selling when it's high, you invest a fixed amount of money on a regular schedule. Every week, every 2 weeks, every month. Same amount, no matter what the market is doing. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, you automatically buy more when things are cheap and less when things are expensive. You're averaging out the cost without thinking about it. This strategy has 2 massive benefits. First, it removes emotion from investing. You're not panicking when the market drops or getting greedy when it rises. You just stick to the schedule. Second, it protects you from making the worst investing mistake, putting all your money right in before a crash. Most investment platforms let you automate this completely. Set it up once and it invests automatically every month. You literally don't have to think about it. The investing happens in the background while you focus on living your life. All right, let's put this all together into an actual beginner portfolio. Here's a simple allocation that balances growth with stability. 70% in a broad U.S. stock market index fund, like the S&P 500 or total stock market. This is your growth engine. 20% in international stock funds. This gives you exposure to companies outside the U.S., adding more diversification. And 10% in bonds or safer assets. This provides stability during market downturns and helps you sleep at night. This is not a get-rich-quick portfolio. It's a get-rich-slowly portfolio. And getting rich slowly is the only reliable way to actually get rich. As you get older and closer to retirement, you gradually shift more money into bonds and safer investments. When you're young, you can handle volatility because you have decades for the market to recover. When you're older, you need more stability. But when you're starting out, keep it simple. 70-20-10. Growth, diversification, stability. Before we wrap up, let me show you the 4 mistakes that destroy most beginner investors. Avoid these and you're already ahead of 90% of people. Mistake number 1, trying to time the market, waiting for the perfect time to invest. Here's the truth. You will never know the perfect time. The best time to invest was yesterday. The second best time is today. Mistake number 2, following social media hype.
When everyone is talking about a stock or crypto, you're usually already too late. The smart money bought months ago. You're buying at the peak from people who are selling to you. Mistake number 3, panic selling during crashes. Markets go down. It's normal. It's healthy. If you sell when everything drops, you lock in your losses. The people who got rich bought more during the crash and held through the recovery. Mistake number 4, investing money you need soon. Investing is for long-term goals only. If you might need the money in the next few years, it should not be invested. It should be in savings. Remember, successful investing is boring. It's consistent, patient, and disciplined. It's not exciting, it's not flashy, but it works. Let me show you the most powerful investing advantage you have: time. Imagine 2 people. Sarah starts investing $300 per month at age 25.
She invests for 10 years, then stops completely. Total contributions, $36,000. Mike waits until age 35 to start. He invests $300 per month for 30 years straight until retirement. Total contributions, $108,000, 3 times more than Sarah. Who has more money at age 65? Sarah, even though she contributed 1/3 the amount and stopped investing 30 years earlier. How? Compound growth had 40 years to work for Sarah, but only 30 years for Mike. This is why starting today, even with small amounts, beats waiting until you have more money. The first $1,000 you invest in your 20s can be worth more at retirement than $10,000 you invest in your 40s. Time is the multiplier that turns small, consistent actions into life-changing wealth. You don't need to start with a lot. You need to start now. All right, you now know more about investing than most people learn in a lifetime. But knowledge without action is worthless. So here's your simple action plan. Step 1. This week, audit your financial foundation. Write down your high-interest debts. Calculate your emergency fund target. Confirm you have stable income. If these aren't solid, fix them first. Step 2. Choose an investment platform. Research beginner-friendly brokers with low fees and fractional shares. Open an account. This takes about 20 minutes. Step 3. Set up automatic investing. Even if it's just $50 per month to start, the amount matters less than building the habit. You can always increase it later. Step 4. Buy your first index fund. Start with a simple S&P 500 or total market fund. Don't overthink it, just start. Step 5. Forget about it. Seriously, set up the automation and then go live your life. Check maybe once per quarter. The less you look at it, the better you'll do. Week 1, foundation audit. Week 2, open your account. Week 3, set up automation. Week 4, make your first investment. 4 weeks from now, you could be a real investor. Remember, you don't need to be rich to start investing. You start investing to become rich. And rich doesn't mean millions. It means having enough to live life on your terms. Here's what I want you to understand. Building wealth through investing isn't about being smart. It's not about getting lucky. It's not about perfect timing. It's about making a decision today that your future self will thank you for. It's about being patient enough to let compound growth work its magic. It's about having the discipline to stick with a boring strategy while everyone around you chases excitement. Most people will watch this video, feel motivated, and do nothing. Their lives won't change. But you're not most people. You made it to the end. You invested 25 minutes learning something that could literally change the trajectory of your financial future. The question is, what will you do with this knowledge? If you found value in this video, subscribe to Smart Money and Finance Guide. Every week, I break down complex financial topics into simple, actionable strategies that actually work. No hype, no get-rich-quick nonsense, just practical wisdom for building real wealth. Leave a comment telling me what's holding you back from starting to invest. Is it fear? Confusion? Not enough money? Let me know because your question might become my next video. Remember,
Small financial decisions made consistently over time create massive wealth. You don't need to be perfect, you just need to start. Your future millionaire self is waiting. Go build that future.